On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope you're all well. Happy New Year. This is the first episode of 2026. I'm actually recording this on New Year's Eve. I won't release it tomorrow. I think I'll wait till the 2nd. That will give all of you a chance to recover. As for me, a fairly quiet night planned, just staying in. Got some friends coming over with their kids, so maybe stay up and watch the fireworks, a couple of Gizzy Golds, spin a few records. Nothing more exciting than that. But anyway, I wanted to kick things off with another recap, and I thought I would talk about a topic that I write about quite frequently, which is the housing market. And the housing market is important to most of us because many of us are either homeowners, if we are lucky enough to be a homeowner, or we are aspiring homeowners. And whether you like it or not, housing is quite a big driver of the local economy because for many people that is their biggest asset and it will always be their biggest asset in many cases. And so it does have a big impact on confidence, on sentiment, on spending, on growth. A lot of small businesses borrow against the house to fund the business. And when your house price is going up, you do feel better about things and you are a bit more active in terms of your spending and your investing and your general attitude. And when house prices are in a slump, it is quite difficult for an economy like New Zealand to do well. We're quite different to the likes of the United States, where everyone has a share portfolio, and when the Dow Jones, the Nasdaq, the S&P 500 are on fire, like they have been, you get that wealth effect that does push your economy along, push consumer spending along. Here in New Zealand, we're not a nation of share owners or business owners. I'd like us to be, and I'm trying to help change that, and it is changing, but we are still a nation of homeowners and property people. So that is why the housing market matters a lot. And let's talk about that because it's been really surprising to many people that the country has dragged itself out of recession. You've seen mortgage rates fall for a couple of years now, down from above 7 to in the mid 4s. That's a hefty fall, but we still haven't seen that long-awaited housing market recovery. We have seen volumes improve. If you look at the Real Estate Institute figures or talk to your local Baileys or Eves agents, then they will definitely tell you that things picked up over that second half of 2025, but we still haven't really seen prices respond, which is really interesting. And when I look at the house price index, and rather than looking at median prices, I always look at the index. So you can find that on the REINZ website, or the Reserve Bank publishes a long-term series of house price indices, and they're really useful for following price trends. The reason that makes a lot more sense to me and to many than the median prices is because median prices can be skewed by what's selling. So if people stop buying the cheaper houses, but the rich people still buy those high-end houses, then your median price can drift up. Because remember, it's the median sale price. So if expensive stuff is selling more than cheaper stuff, then that price goes up. And that doesn't actually mean that house prices generally have risen. They might have actually fallen. So you've got to keep an eye on those sorts of things. Now, the Real Estate Institute's house price index is up slightly this year, not much, less than 1%, but at least it's in positive territory. Last year it was down slightly. The year before that it was up ever so slightly. The year before that it was down quite significantly. So we've basically had 3 years of no change, moves of less than 1% each year in either direction. Before that, you had a very rough year in 2022 where prices fell about 14%, and the year before that we had a cracking year. 2021 prices were up more than 20%. That was when those low interest rates were making their presence felt. So while we have seen a recovery recovery in the economy in recent months, and we have seen falls in mortgage rates, and we've seen volumes respond across the housing market. We have not seen prices move much at all. Now, that's not the case everywhere. I'm talking nationally, and if you look at some parts of New Zealand, such as the South Island, Canterbury, Otago, Southland, they have been more buoyant, and those regions have all seen much stronger gains. So I think it has been a case of a two-speed economy. We've seen that across different industries and sectors in New Zealand, but you've also seen it across housing markets in a regional sense. Many of those agricultural regions have performed better, and in contrast, you've had some of the big metros, Auckland, Wellington, that have done it a lot tougher. Christchurch has been okay. Obviously, they haven't had the same affordability issues that we've seen in other parts of the country. So that's where we're at. It has been a challenging few years for the housing market. So why has that been, and what does that mean for the future? Well, there are a few obvious reasons to explain our housing market going sideways. And for a start, I think affordability is still not as high as we would like. Prices haven't done much for 3 years, and before that they fell 20% from peak to trough. But we've just got to remember that that rise we saw in 2020 and 2021 was very, very dramatic. Prices rose almost 50% in a 2-year period, and that is significant. So even after that decline, prices are still some 25% above pre-COVID levels if you look back to where they were at the end of 2019. Now, wages have grown over that period too. That's really important. So when you factor in what we've seen on the wage front, affordability doesn't look as bad. In fact, on some measures, you could say that houses are more affordable than they were just before COVID hit. But I guess my point is that they weren't particularly cheap back then. And even though you've seen a big slump and then a period of flat prices, they still don't look very cheap. They still look as expensive as they were, or close to it. Now, another factor has been net migration. That's declined much more than expected. It hit record highs a few years ago in 2023, but it really did fall off a cliff after that. And new migrant numbers were comfortably above 100,000 per annum over that period, but they've been less than 10,000 per annum recently, so they really have fallen, and that does impact your housing market. It impacts your economy, it impacts activity across the board. When you've got people moving into the country, setting up homes, setting up lives, doing stuff, buying stuff, that pushes things along, and when that's not happening, it has the opposite effect. So that low migration has been something that has hit our economy and impacted the housing market too. And we're starting to see that turn around. Hopefully, as we have a stronger economy come through in 2026, 2027, maybe we'll see a few more people coming here or not leaving. And the unemployment rate has a big part to play as well. The labour market, that is really important, because job security has been a concern in recent years. The unemployment has been steadily rising. It's now sitting at 5.3%, which I think is the highest we've seen since 2016, and it's certainly well above that 3.2% that we saw during that COVID boom period. So it has risen quite a lot. And I think this is an unappreciated factor that has a big impact on the economy and on the housing market, because it's not just all about interest rates. Interest rates are really important, but the other missing piece of the puzzle that you need for people to be confident enough to borrow a lot of money and commit to that mortgage for 20 years, 30 years, whatever it is that they need to feel that they have job security. And people don't feel that they've got job security when unemployment is rising. They're seeing in the news, they're hearing from friends and family that this person can't find a job, that person's lost their job, that person's had their hours cut. That does nothing for your confidence. So I think we need to see the unemployment rate peak and start coming down. We need to see the labour market strengthen. I think that will happen over the next 12 months, and that will be a really important factor in giving people that confidence to make that major financial commitment, such as buying a home, such as taking on a mortgage. So those are the sorts of things that I'm thinking about as we look ahead to 2026. I do think the economy will recover. Interest rates have come down a long way. We've probably seen the bottom there. So when you look at some of the bank forecasts, and I know ANZ do some really good work about the housing market, the property market, and about where mortgage rates are going, they see the 1 and 2 year mortgage rates by the end of 2026 sitting in the low fives, right? So that would be a lot lower than we were looking at a year ago, 2 years ago, 3 years ago. They got as high as 7.2, 7.3%, and recently they've fallen as low as 4.4, 4.5%. So they might push up over the course of that year. And that's not a bad thing. That's not something to be afraid of, because it will be happening because you've got a stronger economic environment. So I think at around 5%, that's still not a terribly expensive mortgage. It's more expensive than we've seen very recently, and certainly during that COVID era. But you look back through history and 5% is not unreasonable in terms of a mortgage rate. So I think that's a good thing, and that will help the housing market along, as will population growth, hopefully picking up a little bit, the labour market improving as unemployment comes down, and the more general economic environment improving too. So what could we see in terms of price movements? Well, if we look back through history, and I'll go back to 1990, the long-term average over that period has been about 5.7%, right, per annum for house price growth. There have obviously been periods where house prices fell, and there have been periods where they boomed really strongly. But if you draw a trend line from 1990 to today, you get about 5.7, 5.8%. So this year, what should people expect? Well, everyone's got a different view, and no one's crystal ball works perfectly, and predicting things like house prices is a great way to look stupid 6 months later or 12 months later, as many economists and forecasters, including myself, have found out in recent years. But the experts are reasonably consistently picking low single digits. So if we look at the Reserve Bank forecasts, they have got 3.8% this year, 2026, and then 3.7% growth in 2027. Cotality, which is the old CoreLogic, and they do some great work, they've got 5% for this year, 2026. ANZ, 5%. Kiwibank, I like what Kiwibank does. Jared Kerr and his team, always very common sense, so I follow the work that they're putting out, and I think they've got 2 to 3%, which is actually a little on the subdued side. So they're only looking for modest gains, but that would still be better than we've seen for the last 3 years. Westpac is at 5.4. I've been on record saying 4 to 6% range, which I guess puts me at the northern end of that group that I've just quoted. But look, who knows? I think the key message here, whether you're a first home buyer, an owner-occupier looking to upgrade, or an investor, is to acknowledge that the housing market has been through a very sluggish period and it hasn't done too much. However, that doesn't necessarily mean that it is going to boom in the years ahead, because there are still lots of factors holding it back or just creating headwinds. And we haven't even talked about policy change. Will you see a capital gains tax? Will you see interest deductibility changes again? Anything could happen. So lots of reasons to be a little bit cautious. But I do believe that lower interest rates, a stronger labour market, a stronger economy, hopefully a bit better migration, will all combine, and we will see a more buoyant period for the housing market. It won't be stellar gains, but I'm saying 4 to 6%. Kiwibank's saying 2 to 3. Maybe it'll be somewhere in the middle. Who knows? But I think it is a good time for people to buy a home. If you're a first home buyer, you are at the end of a period that has been very good for buyers rather than sellers, but it's been very much a buyer's market. I think that balance will shift a little, that power balance, over the course of 2026. So it will probably become a little bit better for sellers and still good for buyers, but maybe not quite as favourable. So I think it's a good time to be making a move, to be making some decisions. But if you're an investor and you're buying with the purpose of making money, just keep your feet on the ground. Don't just assume that because we've had 3 flat years and then before that a 15% decline, that you're in line for a 15% increase in 1 year, or even a 10% increase, or even 8%. I think that would potentially be unwise to be as bullish as that. I would be expecting low to mid single digits, and if that opportunity still stacks up, or if you see the chance to make some improvements, or if you can buy really well, or whatever the case may be, then go ahead. But just keep your feet on the ground when it comes to those price movement expectations. All right, that's all for today, team. We'll talk again soon. Thanks for listening.
For more insights, visit craigsip.com.